afternoon, good evening, everybody. This is our most important podcast yet. It's been a very turbulent week in markets, all kinds of different moving parts and information floating around out there, and thought it would be a great time to update you on everything that's happening here at Avenue. And Bill, wow, what an amazing week. And it just makes you wonder, why are we doing this? Why are we why are we investing? Why are we
It was an extraordinary,
market?
amazing week, an extraordinary week, a pretty crazy week. And I think this is, the idea today is just to try to put it in perspective and give us our take on it. And really, we sent out a note last night just to organize our thoughts. We all collectively got together, said what was the experience the last couple of days. And I think it was one of those 10,000 foot views of saying, like, why are we doing this in the first place? And just really emphasizing what the point is. To compound our money long term, we do have to own stocks. These are the simple things. We can't just run and hide whenever we want to. This is the core idea is Avenue Investment Management takes money and we invest in the stock market. The second piece, which we do know, is over history. We focus on these income producing businesses, and 2/3 of our return will actually be from reinvesting the dividends over time. So we only get the dividends if we own the stocks. And so we also know that the third piece to all this investing is that we know stocks can go down a lot occasionally, and it's most likely that we won't know when that's going to happen. So a lot of Avenue strategy is mechanisms of saying, what are the types of businesses we're looking for, and then how can we make it so that we have the discipline to stay invested and keep reinvesting.
Absolutely. You're trying to keep up with inflation and make sure not to erode your purchasing power over time. Obviously, it's very difficult to live in the bond market given where interest rates are today, and you need a rate of return out of your money, and you want to be able to keep up with inflation over the long term. But let's get into, I'll get into anyways, what happened this week, and let's talk about it. I mean, you started off Monday by having the largest down day in 30 years on the TSX, only to be followed by several days later the worst stock market down day since 1940s, and on the U.S. side since Black Monday in 1987. And what amazed me is the sheer speed of how this all fell apart and how there was absolutely nowhere to hide. And if I may just take a step back, just leading up to this, and I know our listeners have heard us talk about these things in the past, but just to recap going into this. So we already were aware that valuations were stretched. We were already aware that there was no earnings growth in aggregate. The U.S. consumer had been 70% of GDP is tied to the U.S. consumer and been holding the economy in, and we were starting to see cracks there. And the data had already told you you're in a manufacturing-based recession. You had central banks pumping liquidity into the system. Since September, all markets everywhere had gone up. And out of nowhere, you have this whole coronavirus scare, which has created a lot of panic, and rightfully so, but no different than other crises with SARS or MERS, or going back through history, looking at these temporary things. And then you had a one-day shock where the Saudi government's playing a game of chicken with the Russians, flooding the market to try to bankrupt the U.S. Shale players and wreaking havoc on the market. So going into this, we were already positioned defensively, but the sheer speed and volume of this, to see whether it's quality, non-quality, income-producing, resource-based, real estate, everything got hit equally. And I think a big part of that, and I'll ask you about this, Bill, is just the ETF, that churning this whole ETF effect, turning half the stock market into effectively different ETFs where everyone's hitting the sell button. And the other thing is these bank products, and I'll let you touch on that, that are being liquidated.
Yeah, I think we want to turn it exactly this conversation into dissecting what happened and what we did about it. And the most important thing we'll finish up on is how are we going to get out of this, and how do we, how can we build strength in the portfolio and come out of this with a much better group of stocks and income producing, our strategy. So, yeah, we were saying 3-4 weeks ago, like that, how little time has passed. And the extraordinary thing was saying all this liquidity that was going in the stock market, how it's just driving stocks to new highs every single day. We were already nervous. We were defensive. The economy was actually slowing down in the face of this. And the extraordinary thing about the virus is we sat there, for 2 weeks of saying, well, this isn't all that bad in terms of nothing is really happening. We know that the virus is going to probably shut down parts of the economy for periods of time, but it is still an event that takes place over a shorter period of time and is something that we will go through. And the stock market was holding up relatively well. And I'd mentioned that this time last week, going home on Friday afternoon saying, well, that was an exhausting week, but we'd actually held up pretty well. Then over the weekend, the virus, really just hit Europe and hit North America, and then we had the OPEC news. And so the critical piece, and I don't want to drag too much airtime on this, but it's when the ETF market, all these people came in on Monday morning and said, I really feel uncomfortable owning stocks. And the way the market is right now, saying, I would like to be out of these for a few days, you hit sell on your button, and there was nobody to sell to. That's the experience that we had in 4 days, was just an elevator ride straight down.
And to touch on that, you saw firms in the U.S., online brokerages, I believe it was Robinhood, shut down their online trading platform. I had a client call me yesterday, not being able to enter orders, sells or buys on his web broker account. So you also had earlier the TSX and U.S. exchanges shut down for periods of times, whether that's for technical reasons or to stop panic. But I suspect this whole wave of indexing and hitting the sell button at once is overwhelming the system and has led to this whole correlation, this panic correlation in the short term going to one, meaning that no matter what you own, you're selling it, and in the short term, everything becomes correlated, and then over longer periods of time, you start to deviate, what's quality, what's not quality.
Yeah, and I'll throw that back to you, just emphasizing that point, because we had some comments. Well, you had gold, and how well did gold work as gold itself held up, but how did the gold stocks do?
Oh, so that's a great point. So a lot of the gold stocks are probably flat year to date. Gold stocks had run up going into this, and there was a few, not more than a few, hedge funds or institutions liquidating their gold stocks to cover shorts and margin calls and other positions. And you also then got caught in this undiscriminatory selling, where you're just selling everything down, but the price of gold is actually up. And you realize already what the Fed has come out and announced, which is more liquidity and more money being put into the system, and I assume very shortly more stimulus to follow. That's extremely bullish for gold and the markets and gold stocks. And when you look back to the first round of quantitative easing in 2010, gold ripped much higher.
Yeah, this exactly the point. You brought this up earlier in the day. We use these terms like sort of adding liquidity to the system, which is just the central bank has a way of create money. And we had a lot of money before this. We're going to have more money after this. Interest rates are still really low. So we do know that the framework of this is, in a couple months' time, we have to own stocks regardless. And then how are we going to get from where we are today? Can we, with our cash, we can add to positions, but we do know that we absolutely have to be invested coming out of this.
Yeah, and one of the things that we've been able to do, I know clients have seen a fury of activity, and really what that is, well, one, you used to be able to live in the stock market and get your 8-9% dividend, and you didn't really have to trade all that much. Then markets had run up, and to get a rate of return, you had to be a little bit more active to take advantage of capital gains opportunities. But what you're seeing now is the risk management process, where you see this flurry of activity, and you go, well, certain stocks have broken down, or there's big valuation distortions where I can high grade the portfolio. So all I'm trying to say in the most basic terms is, yeah, maybe we've been a little bit early with some of the transactions we've made, but through this whole process, we've been able to high grade or increase the quality of our portfolio. Those, there were some REITs that were trading that were very stable apartment buildings that were paying out, a 3%, 4% dividend that are now paying out a 6 or 7% dividend, and nothing's changed in their business. So we've been able to reposition the portfolio, high grade the portfolio. The dividend yield is now, I think it's 5.5 from 4.5 down to 4 with the run up in markets, and just knowing that coming out of this with that gold piece or with the infrastructure piece or utilities piece and this hoovering this income coming into the portfolio, that we're going to start to diverge and come out of this more successfully.
Yeah, I just want to emphasize that piece too, is that we came into this extraordinary week defensive, but when markets are going down that fast, it's really hard to do anything. Actually, the discipline is to sit on your hands, but we actually did do a handful of trades, and they were all sort of, when there are moments in time, can we switch things and really, it's a mining term like jargon, but you're high grading what you own. If I'm not sure about this investment, but this is a great business, but it's been expensive for a while, we have a incrementally different portfolio at the end of the week that we had at the beginning of the week. And I would also say that we started the week with 10% cash, and we actually spent 4% of it yesterday, pretty close to the bottom. And that's the first time we've really gone into our cash going through this period.
It feels terrible. I know that we've been here late nights for the last 2 weeks and going through this, but when we're trying to be self-critical or self-analytical, saying, what could we have done differently, or where could we have hidden? And I think the answer is, I don't think we could have done anything, hid anywhere.
Yeah, we've spent every morning going through what we own, why we own it, should we be doing something different? You start up before the market opens every morning, where do you want to be? And that was in the note we wrote last night, was really the paradox of doing this type of investing where we've got all this dividends coming into the portfolio all the time, which means we're not market timers. On just a regular week, we're constantly looking at things to buy. So the irony is the paradox is when stocks are down, it is better. We get to buy these great, hard asset income producing businesses, and we get to buy them cheaper. The paradox is it just feels awful when you're getting that opportunity.
Now, not to throw you for a real loop, and this is very, very hard for the average client to understand and wrap your head around. But Warren Buffett has wrote about this at length. There's also a difference between risk and volatility. They're two different things. So if you're in a market like this and a crappy resource company falls 50% and a high quality apartment building that's fully tenanted falls 50%, which is a less risky investment?
Yeah, I'll tell you. Well,
there's a big difference.
You threw it out that way. I come back. This is my experience, the 2000, and Warren Buffett would throw out those lines saying, when the stock market goes down, stocks are on sale. This is great. And then having tried to read most of what he's written and relate it to our strategy and how we can apply that to the Canadian market and a Canadian pension style investor, what he's not saying, and I've never seen him written anywhere, is that when stocks go down, some stocks are good value, other stocks are going out of business. So it's really the focusing on, and the big move we did, and it took a lot because we've owned Keyera and Inter Pipeline, for almost a decade. But the difference is, I saw that we traded in and out of Keyera once based on interest rates, but Interpipe has 20-year fixed contracts with Suncor and Canadian Natural Resources. Keyera doesn't have those type of contracts. And so exactly when everything's going down, everything goes down equally. And what we believe over the next 2-3 weeks, couple months, now the stock market will sort out who's got a solid business model and who doesn't.
But even taking the 20-foot view, and just to get away from the stock talk or the market talk, the one thing that did work, and it amazed me over the last number of years, especially in 2017-18, when interest rates were in the bond market were starting to slowly rise. investors saying, well, why am I in bonds? And more specifically, why am I in investment grade or government and provincial bonds? Because the yield is so low, and even when interest rates go up, on paper, I lose a little bit of my principal, and it feels terrible. But when you're on in your darkest hours, once again, asset allocation did work, where you have the clients of ours that hold bonds, which a lot of you do because you're retired or you have a certain amount of cash flow that you need out of the portfolio, or don't have a pension plan, and we've modeled this out, which whoever you deal with at Avenue, whatever portfolio manager you deal with Avenue, really does their best to try to understand your life. It has worked.
Oh, and you've had a lot of conversations about that this week.
Oh, absolutely. I've had a lot of conversations where no one's complaining about their bond exposure being 2% now, and more importantly, where you saw
the rate of return. So you said
so this
is the thing, we've owned bonds, but we're in a very low rate of return environment. But the bond portfolio serves a very specific purpose,
which is principal protection, being able to provide liquidity. For the worst thing you want to do is to have to call up and sell your stock portfolio when the market's down 20%. You want to have that bond there, that bond portion there, even though it's uncomfortable. And what is amazing to me is just how defensive we were in the bond portfolio. And you saw this real reach for yield that we talked about in previous podcasts, which meaning high yield bonds or unrated bonds or bonds that are not as credit worthy, or going farther out, 30 years out, and locking in money, as opposed to maturing things in investment grade or companies with good credit rating in short order. And what have you seen? Well, you saw the high yield market starting to go down a lot in the United States. In Canada, a large part of the high yield market is tied to oil and gas, and you're starting to see credit spreads blow out. But what are your thoughts on that?
Yeah, so this is actually the last piece. Maybe I'll touch on this because it might have even come up at the beginning of the conversation. So far, we believe that the event we had in the last week is really nothing like 2008. 2008 was a global financial crisis where the banking system glued up, where it said if there are no banks and I needed to buy a car, Matt, I would come to you and say, Matt, could you lend me $20,000? Because there's no money from anybody. Like when you shut down the global banking system, that's what the world looks like. This is not like that at all. This is so far, because we just don't, the industries are closing down, events are stopping, people aren't traveling. But we don't know what earnings are going to be in the market, in which case there's almost sort of maximum uncertainty today, but for a period of time. So this is an earnings holiday, not a financial crisis. But exactly the point you're touching on, if certain businesses sort of have to suspend their business for a certain amount of time, does that become a credit crisis to them? They're not able to service their debt. If they're not able to service their debt, does it hit the banks? And that is still unknown. A lot of the bond market started reacting even just in the last 24 hours, but we wouldn't see any of that impact for the next couple weeks or month. And again, and we'll probably want to end up on this, conversation today, is we're putting money to work, but we're going to be patient.
Oh, absolutely. And if you look at, we talked about rate reset preferreds, or some of these convertibles that weren't backed by, or they were backed by companies that were on the cusp of being credit worthy, to try to squeeze that extra yield. It worked great in an up market, but when you go through a situation like this, and your retiree saying, I just need my money out of the portfolio to live my life, that's where you get into trouble. And I'm happy that the Avenue bond strategy has been as defensive as it is to provide that principal protection for the cash flow for clients.
Yeah, we don't do any of that. And as I said, this is a very vanilla, owning credits we understand, owning businesses we understand. But to your point, I think there's going to be lots of noise going through this. There was maximum uncertainty, certainly in the last 48 hours, but there's going to be lots of noise as all these repercussions go through all, the financial world, the banks, and what we're trying to do is stay out of all of that. And again, but still, what I would want to leave on is that it doesn't change that interest rates are low, and we do need to own stocks going forward. It's just how we're going to get there. And we've spent the last week trying to, make sure we've got the best quality portfolio that we can put together.
Yeah. So if you look at it that way and you say, well, both in Canada and the U.S., rates have fallen. If you're going into recession or already in recession, and you have a certain part of the consumer spending coming offline because of the coronavirus or because of the oil shock to the system, if rates continue to fall here and are already at historic lows and probably trending lower, and you need a return, if you need a return on your investment and you can't live your life off of the returns in the bond market, although it serves a purpose, you can't live your life off of cash, where else are you going to be? You're going to want to own assets. And if an income stream is backed by a hard asset like real estate or infrastructure utilities, is trading at, let's just make up a number, 15 to 18 times earnings in a zero interest rate world, you would suspect that multiples get re-rated much higher, and these assets and these income streams are much more valuable in today's environment going forward, especially with the amount of stimulus coming down the pipeline. And if that was too technical, I'll let
Well, I'll
say it in
simplify
simple terms.
From a stock market point of view, and we've spent the last 24 hours discussing this, which is we are in recession right now. Yes. It seems like 2 years ago we had a rail strike in Canada, but that was about 2 weeks ago. And we already have slowed down the manufacturing base in Canada. The oil and gas industry has just been completely pummeled. Rail has been shut down. And then we have this, but the stock market is today, we would believe, is discounting a lot of that. And so you have to get your head, this is happening, and a lot of it has happened. And now we got to get our heads around how we're going to come out of it.
So the Avenue strategy has not changed. You still are owning these different pieces. You're still focusing on free cash flow, on generating dividends. You're still doing your valuation work to make sure you pay a fair or good price for your assets. And I particularly really enjoy this gold piece to our portfolio as central banks continue to stimulate. I think you're going to see gold go much higher. And although it hasn't felt good in the short term, meaning the past week or two, I think you're going to see that pay large dividends going forward.
Yeah, and that's sort of going to be a lot of the conversations going forward for the next year will definitely be about, sort of what's happening with liquidity and central banks. There's going to be really fun, exciting podcasts, for the rest of the year. But hopefully, this, in terms of extreme behavior, this is so extreme that we really hope the majority of this is actually behind us, and we have to start looking forward and how we're going to be emerging out of this.
So I know we've jumped around all over the place. Sometimes we're too technical or not technical enough. But really what we're saying is this. One, when you go through these shocks to the market or crises, the worst thing you can do is panic or sell assets on the low. In fact, it's an opportunity, especially if you're able to buy stable cash flows. Number two, asset allocation is working and risk management is working, and bonds do play a role in your portfolio, especially for retired clients. And three, if you don't have a financial plan through Avenue, and a lot of our clients do, a lot of our clients don't, or haven't really thought about it, get in touch. And when you look at your broader financial plan, that the pieces do work, where's your money coming out of your portfolio, so you can ride these peaks and valleys through being an investor.
Oh, and absolutely. And any questions, whether it's email, phone, getting through this, it really helps us to talk about it, constantly talk about it, and think about what we're doing in any way we can help.